And we have here Ed Sullivan, who is the Group Vice President and Chief Economist for the Portland Cement Association, and Pierre Villere of Allen Villere Partners, and longtime columnist for the Concrete Producer magazine. So gentlemen, just to start off, obviously it's been a pretty good year since last time we met last year this time. Unemployment is down, fuel costs are way down, GDP is up, and it just looks like it's a very good environment. Stock market is up, although it's been wiggling the last few weeks. So what do you both see for the future of the economy, the construction industry, and cement and concrete production? Pierre?
Well, I'm going to start by going through this presentation here shortly that is more focused on concrete and the effects of the concrete business, but really everything that Ed has to say is intertwined with what I have to say, because cement, you don't produce a yard of concrete unless you use 450 pounds of cement or so. So I would tell you that the direct answer is, you know, we follow Ed's work very carefully. We're in complete agreement with his view that we're probably, you know, 8% growth. There's a direct correlation to cement production and concrete production. So, you know, we believe that it's a 450 million cubic yard business by 18 or 19. So we're extremely bullish and certainly feel a lot better about the industry than we have the last 5 years. Okay. So with that, let me go through my presentation here, and okay, I guess I've got a point in this direction. Let me walk through the key factors that are driving the recovery. There's a steady drop in unemployment, a significant increase in consumer sentiment, the gas price dividend, advances in the stock markets, recovery in all segments of the economy, and the unleashed potential of the millennials, and a very upbeat housing outlook, particularly for 2015. So let's talk about the steady drop in unemployment. Unemployment peaked at 10% at the height of the recession, and non-farm payroll employment increased by 252,000 in December, seasonally adjusted, and by 2,952,000 over the last 12 months. So this is almost 3 million jobs that have been added in the last 12 months. Construction employment rose by 48,000 for the month and 290,000 over the year to 6,166,000, the highest total since March of 2009, and the largest annual increases since 2005. Residential construction employment, this is the residential building and specialty trade contractors, climbed by 13,500 for the month and 132,100 for the year. It's significant to note that's a 6% increase, and looking into the crystal ball, we think we will substantially exceed that in 2015. Non-residential employment for building specialty trades, heavy and civil engineering construction increased by 34,400 in December and 158,200 year over year. So good trends in the drop in unemployment. This is a particularly interesting statistic. The number of job seekers who last worked in construction dropped from 958,000 in December 2013, not seasonally adjusted, to 680,000, the lowest December total since 2000. That's a pretty significant, that's 15 years. Today, unemployment has fallen to 5.6%. There's a significant increase in consumer sentiment. The consumer sentiment plunged to 55 on the Thomson Reuters University of Michigan Consumer Sentiment Index at the height of the recession. The Michigan Index reached its highest level since July 2007 last month. The Conference Board Consumer Confidence Index also increased sharply. Here's a look at the 3-month moving average on the following chart. And if you'll see here, it's very interesting how both, the Conference Board, is this pointer working? Laser pointer is not working, but I just want to mention that you'll see that the Conference Board and University of Michigan lines track each other pretty closely, and there are two significant drops in consumer sentiment here. One is here. And does anybody know what that is? That's 9/11. And then, of course, the other very significant drop that occurred as a result of the financial crisis in 2008 and the subsequent collapse of the economy in 2009. Okay. The Consumer Sentiment Index increased to 93.6 in December from 88.8 in November and 82.5 during the same month a year ago. This is pretty significant increases. The survey's measure of consumer expectations rose to 91 in January 2015 from 86.4 in December and 72.1 in January 2014. Significant improvement in consumer sentiment. The Conference Board Consumer Confidence Index increased to 92.6 in December from an upwardly revised 91.0 in November. The survey's expectation index increased to 88.5 in December. The gas price dividend. Don't forget about gas prices. This is a highly visible equivalent to a raise, a dividend, or a tax cut, and is a huge driver of consumer sentiment. I've met some very smart people throughout my career that say that 70% of the American economy is driven by the consumer. And a friend of mine who's a car dealer at home says that the American consumer is the lady at Walmart spending her and her husband's paycheck on Friday afternoon, and they drive the entire American economy. The estimate of savings to consumers range from $60 to $75 billion a year, which is pretty significant. This estimate translates into approximately $550 per household, based on the most current gas prices. Advances in the stock market. The Dow Jones Industrial Average bottomed out at 65.47 in March 2009, wiping out 54% of market value in 17 months. Since then, the market has recovered to a trading range of around 17,500 in less than 6 years, a collective gain of 267%. The improved balances in U.S. portfolios has a huge impact on sentiment. Recovery in all segments of the economy. Major segments of our economy have recovered strongly, specifically automobile manufacturing, hotel occupancies, the restaurant industry, and retail across the board, from luxury goods to mass merchants. And we expect that construction will be the next bright light in the economic picture. I like to discuss this topic because I think this is the wild card in our economy, which is the millennials. A record number of individuals aged 18 to 34 years are delaying household formation as a consequence of the Great Recession. Slow wage growth and rising student loan burdens have deferred marriage and home ownership. Here's what the survey found. Over the next 5 years, 8.3 million new millennial households will form. That's a pretty remarkable number given the household formation runs in just slightly over 1 million new households annually. 74% plan to move over the next 5 years, with the top reason being the need for better housing. 64% expect to be married in 5 years, and 55% expect to have children. 75% believe home ownership is an important long-term goal, and 73% believe home ownership is an excellent investment. 24% currently own a home, and another 60% plan to purchase. 36% expect their next home will be a multifamily rental, while another 36% expect it to be a single-family owner-occupied resident. 75% want to buy a single-family detached home. 66% would prefer to live in the suburbs. 24% would opt for rural areas. Only 10% would choose to live in the central city, which is way down from 2008. A larger share than among Gen Xers, baby boomers, or seniors, but still a minority share. That number is way down from 2008. 88% own a car, and student loans do delay home ownership, but college raises lifetime incomes. An upbeat housing outlook. The final new housing starts for 2014 was reported at 1.006 million starts. Projections from NAHB, National Association of Home Builders, call for single-family production to rise 26% in 2015 to 804,000 units. On the multifamily front, 358,000 starts are predicted, up 2% from 352 last year. Multifamily is starting to flatten out, we believe, and I think that you'll see a significant improvement in single family. This totals 1,162,000 starts for 2015 based on NAHB statistics. While this is an improvement from the peak of the recession, it's well below the historical average of 1.6 million. Here is a look at housing starts, and you can see how grim it got. In 2010, we had as few as 2011, we had 306,000 new family sales, and housing starts bottomed out right before that at 586 in 2010. I love this. This is a chart that shows the cumulative excess or shortfall, and most specifically, you can see that we had an excess in 2006 of 350,000 dwellings, and that we have over time, as lower starts have collectively created a shortfall. We're showing in 2014 a 4.5 million start pent-up demand. This shows us where that steady state of 1.6 million units comes from. 1.35 is in household formations. 150,000 is in second homes. There are 300,000 that are just replacement of existing housing stock. That totals 1.8. We subtract out of that 200,000 manufactured homes a year, and the steady state demand is 1.6 million. So there may be as much as 4 million, it's actually 4.5 million units of pent-up demand based on population growth, and this will grow even more in 2015. All right, I've got just a few more slides. The contraction in the ready-mix concrete production has finally turned around. In 2005 and 2006, we produced almost an identical amount of cubic yards of concrete. And there is a belief in the industry among our clients that during that time there was probably a demand of over 500 million cubic yards, and the industry simply couldn't deliver it. There was not an extra driver, an extra mixer truck, or in a lot of instances an extra ton of cement to be able to meet the demand in the market. In 2007, we recorded a 40 million, almost 40 million cubic yard drop. It was the largest single drop in a year since NRMCA and actually my late partner Bill Allen, when they started together tracking this in 1975. Significant drop. The industry had never seen anything so bad. This is largely attributable to the 2000 slowdown in housing starts in Florida, Arizona, Southern California, and Nevada, Las Vegas specifically. Then in 2008, the other shoe dropped. We saw a significant reduction in non-residential construction, and we dropped to 351.7 million cubic yards. And then in 9, we dropped almost another 100 million cubic yards to 258.6. We stayed there in 10. In 11, we saw a slight increase to 265. In 12, we climbed to 289, been a very, very slow recovery. And in 2013, we did 300 million cubic yards. And we will see for the third year in a row of continued volume growth, as we estimate that final 2014 production will be 325 million cubic yards. And this is down from our prediction of 342 million at the beginning of the year after a wet and cold spring nationwide that slowed the start of the selling season. And there were just a lot of parts of the country that never caught up. So we call this the Great Delay. It's been such a slow recovery. And you can see the 2005 bar, 458 million cubic yards. When we dropped to 257 in 2011, we were down 44% from the peak. The year that just completed, 2014, we believe will end at around 325 million cubic yards, and that is up 26.5% from the bottom. So here are our concluding thoughts. The biggest risk for our industry faces as we head into this upturn are, sorry, I said this a year ago, nothing has changed. Dealing with the potential for good growth and the strain that they will place on working capital and deferred CapEx. Major issue in our industry. Supply shortages will then follow in mixer trucks, in personnel, which both of those have been an issue in 2014 already, and eventually cement, although our feeling about this has changed in the last 60 days because we think that the slowdown internationally is going to positively affect cement imports in the United States. And Ed certainly knows a lot more about that than we do. The industry has turned the corner. It turned the corner in 2013 for the first time, and we saw an increase in volume to 300 million cubic yards. We finished 2014 at close to 325 million cubic yards, and we expect 350 to 360 million cubic yards in 2015. There actually could be more demand than that in 2015, but we think that personnel issues and drivers, CDL drivers in particular, are going to continue to be a challenge in the fastest growth markets. This is close to 100 million cubic yards more than the trough, raising questions about the ability to handle this growth in an equipment and personnel constrained industry. And specifically, using NRMCA metrics, 100 million cubic yards is 20,000 mixer trucks that are not on the road right now. Our industry's recovery will be at least a gradual, if not robust, growth cycle that has clearly taken hold. Sometime in the foreseeable future, expect shortages in raw materials, rolling stock, and equipment essential for the next growth cycle. This will emerge on a market-by-market basis. In 2015, we expect a full recovery will be firmly in place with accelerating growth due to pent-up demand. So, with that, I'm going to turn it over to Ed.
Tom, you know, I'm going to react to I think Pierre's points. I think this is a historic day, and it happened at the World of Concrete. You've got two economists sitting on the same panel, and we agree. Weather report, hell, has frozen over. Look, that was a very good and thorough presentation by Pierre. We agree with many of the points. I can tell you I am perhaps even more optimistic than Pierre in some of the discussions. Let's look at a couple things. We talk about oil prices. There's no question the job creation, the consumer sentiment, driving consumption and driving the economy. We're expecting 3.2 to 3.4% GDP growth, and it could be even stronger. But if you look at that oil issue, I think Pierre had an estimate of 50 to 70 billion. We have it considerably larger. Just a matter of figuring out what the gas price is and how many cars are on the road. And it could be a much stronger push in terms of overall economic growth. And again, that will spell a difference. The second thing I think it's important to recognize is as oil prices go down, consumers benefit. You're benefiting at the pump. You're benefiting by putting less in your heating expenses, etc. But what if you happen to work in a state that is highly reliant on energy production? What if you are in those states, North Dakota with the shale? You will get disruptions of economic growth. So overall, it's very good for the economy. It will add. But there will be regional disruptions. And that will color your way through in terms of construction activity. For a lot of the reasons Pierre mentioned, we believe construction activity was going to grow at about a 6% pace compared to a 3% pace last year. But the oil impact will benefit the economy. It will eventually strengthen non-res and potentially even residential. But you know what? It's a long timing lag. Those impacts will occur in 2016 and beyond. It takes a while for that to be digested and show up in construction. In contrast, drilling activity will respond immediately to the price cut, and you could see a decline in overall construction net this year. Positive next year, this year a little negative. And that's one of the things when we take a look at this, we're in line with everything, could be marginal changes. The other thing I think that should be pointed out here, when Pierre discussed the residential, if you looked at the numbers in the survey of millennials, et cetera, and you look at how many households will be formed, I did a quick calculation. 5 years, 8-point-something million. You're talking 1.6. Then you've got demolitions, you've got vacation properties. You're talking about the potential of housing starts in excess of 2 million starts a year. If that happens, we have a much stronger outlook than any of us are brave enough to predict at this point. Unbridled optimism. Third point, on non-residential. It's not so much the increase in non-residential construction activity that's occurring. It's in addition how much cement and concrete play in that. And we've seen cement and concrete intensities rise dramatically over the last couple of years because they fell off so dramatically during the recession. Finally, when we look at the public side, you hire a worker, you just hired a taxpayer. State fiscal conditions are improving rapidly. And let's face it, over the last couple of years, state governments had to make some priorities. They had to make priorities between pills for grandma and paving the road. And grandma won every single time. And now what we're looking at, as those fiscal conditions recover, perhaps a re-emphasis on those areas they neglected during the downturn. And you know what? That's infrastructure. And that's where concrete and that's where cement play. So when we look at this, I think we have, again, a historic occasion. We're almost identical. This will not happen, Pierre. If we come back next year, there's no question, it's not happening again. And if it does, then you know. But I guess to wrap up, I echo what Pierre presented here. It's not only strong growth for construction, for cement, for concrete this year, 8%, but we're expecting it to be even stronger next year by another 8%. And the potential is, at the end of our 5-year forecast horizon, our past peak in 2005 of 120 million tons, a new record by 2019, 2020. And so with that, I echo the optimism.
Thank you. That's terrific news. Pierre, quick follow-up. The record ready-mix production, I think, was 458 million yards in 2005.
That's right, yes.
Do you ever see us getting up to figures like that again? And if so, how soon?
Well, I agree with Ed, and just to make a comment, you know, we kind of hang on everything, every word that Ed says, which is the reason we sound so much alike. You know, we like his research, and he's been remarkably consistent. But if we hit 120 million tons of cement, that pushes, when you consider the utilization of cement in ready-mix concrete, that pushes us back up by 2019, 2020 in the 450 million cubic yard range. So we completely agree with Ed. We think before 2020, we'll be at the 2005 and 2006 highs again, if we don't have a black swan event. That's the only thing that I caution.
Okay, and that puts a lot of strain on existing and new equipment. And you mentioned in your presentation capital expenditure is a big issue. We have thousands of people here looking to sell and buy equipment. Could you expand on what you meant by that?
Well, throughout the recession, and in a much more expanded presentation that I make, I talk about the metrics of the industry and the very little free cash flow that the industry, or EBITDA, that the industry has generated for 6 or 7 years now. And so what happens when your business is not generating positive cash flow? You're not replacing equipment. There's not the free cash to replace equipment. So throughout all aspects of our industry, not just mixer trucks, but loaders, conveyor systems for those that are vertically integrated in the aggregate business, crushers, screens, you can go on down the list. All of that equipment is in tough shape, and there's a huge demand. I'll mention that a large producer in the Midwest shared with me that he bought $6 million worth of new mixers last year and $7 million this year. So, and he's got a long way to go to get caught up. So I think that's, we're investment bankers, and that we think that that equipment, that CapEx is going to be a big and financing for CapEx is going to be the biggest challenge the industry faces over the next 2 or 3 years.
Okay, and a quick follow-up to you, Ed. Obviously, asphalt is a big competitor to the concrete industry. It seems like with the collapse in oil prices, we should have seen a fall in asphalt prices, but I don't think we have. Could you explain a little bit about that?
Yeah, I think we're looking at it the wrong way. We look at oil prices correlated to asphalt. And you can look historically, it has. As oil prices drop, asphalt prices drop. Historically. As oil prices rise, asphalt prices rise. It's a reflection of input factor costs. It's cheaper to produce asphalt. It's reflected in the market. So, since November, we've seen oil prices drop 50%. And during that same period, asphalt prices continue to rise. In fact, asphalt prices right now are at a historical record high. What we found out is recently that the correlation that you normally expect between oil and asphalt has been broken. It's market dynamics that are in play now. Think of what's happened. Technology has been introduced. Many oil refineries looking for higher margins have installed equipment called cokers, which refine the barrel of oil even tighter. And when you do that, there's less sludge, less bitumen, less liquid asphalt. Supply contracts. And at the same time, the economy is gaining its footing. More paving activity is occurring. So what we're seeing is the potential of supply shortages relative to demand. As a result, those factor costs, while they're pushing that down, are not materializing on the market. Now, is it potential that we'll see asphalt prices come down a bit? Sure. But right now, we used to think it was $71 a barrel that we were price parity with asphalt. I don't think that holds anymore, because there is a resistance because of market fundamentals of asphalt prices declining. More importantly, when we look at this, these DOTs, when they start specifying for road, they must not just look at the near-term cyclical elements, but let's look at the long-term elements that force asphalt prices and oil prices. And unless you can make an argument that economic growth in China and the emerging lesser developed countries stops, then you're going to get continued pressure on commodities and particularly oil. In a long-term perspective, concrete, paved roads not only will regain and expand upon its competitive advantage, we'll broaden it. We'll broaden it to include overlays and FDR and RCC types of pavements. So I think it's still a pretty good story there for us.
Okay, great. Are there any questions in the audience for our two panelists? I don't think so. Well, thank you both for coming, and the news sounds great, and it's great news for everyone here at World of Concrete.
Thank you,
Thanks
Tom.
again, and enjoy the show, everyone.